Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Sunday everybody. First of all, some of you may be asking, Tony, aren't you supposed to be on a flight? Well, unfortunately my flight was postponed 48 hours and I am sitting in a airport hotel. My recording equipment is actually in my luggage, which is currently still with the airport, and so my apologies first of all for the suboptimal quality of this particular recording. I do not have my regular recording equipment. It also means that there will not be an episode on Monday, and there may not be one on Tuesday either, but it does mean that I am able to put one up today. So for today's episode, I just wanted to wrap up some of the key economic developments from the last week, so that when we move back into regular episodes either on Tuesday or Wednesday, we can focus on the new week ahead. Thank you everybody for your patience. Okay, with that said, let's jump in. Okay, let's begin with a deep dive into China's trade performance in December and 2022 generally. According to data published by the General Administration of Customs on Friday, China's exports fell further in December, declining 9.9% in US dollar terms year on year. This is a deeper year-on-year drop than what we saw in November, which saw a decrease of 8.7%. Exports have been hit hard in Q4 with the combination of weak global demand and zero COVID disruptions. However, we note that due to a decent Q1 for the full year of 2022, PRC exports actually rose 7% to a record $3.6 trillion, resulting in a trade surplus, again a record of $878 billion. Quote, as expected, December's export and import numbers were terrible. China's trade surplus this year is 31% higher than last year's record $676 billion. This illustrates the problem with China's weak domestic demand. A surge in exports could not be translated into enough of a surge in wages to drive imports commensurately. Most analysts expect, and I agree, that exports this year will perform poorly, at least in the first half, which in China's case would normally imply that imports will fall in line with exports. I expect, however, that China this year will aggressively boost export performance, and because, as always, this is likely to come at the expense of domestic demand. While the decline in exports will be better than expected, the decline in imports will be worse. End quote. What are other analysts saying? Well, Zhang Zhiwei, chief economist at Pinpoint Asset Management, said that the weak export growth in December highlights the importance of boosting domestic demand as a key driver of the economy in 2023. More on this shortly. And there's this observation, quote, disruptions from the virus surge following the end of COVID-0 were part of the picture, but the bigger issue is slowing global demand. This means domestic investment and spending will have to carry more weight. We think the damage from the current COVID wave will pass quickly and that China's policy pivot towards reopening will allow domestic activity to pick up. End quote. Again, more on this later in the episode. Now, while we're looking at the trade numbers, let's dig a little bit more into the data, and there are some very interesting points that we need to examine. China's trade deficit with Russia reached a record $40 billion in 2022. I should say just shy of $40 billion, with imports jumping 44% year on year as global energy prices surged following the latter's invasion of Ukraine. After the imposition of Western sanctions on Moscow, China, along with India and Turkey, remained one of the few buyers of Russian crude oil. PRC trade with the United States was stagnant in 2022, with exports growing just 1.2% year on year to a little over $500 billion, and imports falling 1.1% to $178 billion. So again, quite a large trade surplus with the United States. However, the most interesting and painful details of the data was that in 2022, China's imports of integrated circuits declined for the first time in almost 2 decades. Imports of the integrated circuits fell 15% in 2022 year-on-year. We compare this with the 17% growth in 2021 and a 22% increase in 2020. We remember last year that the United States imposed restrictions on the export of several types of semiconductors used in artificial intelligence and supercomputing. Now, on the positive side, automobiles and chassis, especially EVs, were China's top export in 2022, with the value of automobiles exported soaring 74%. In the next episode of China Update, we will be looking at China's EV performance and ambitions. After a bad 2022, EV, electric vehicle production and exports, was one of the few bright spots for the economy. Iron ore imports plunged nearly 30% in 2022, reflecting not just the retarding effects of zero COVID on economic activity, but also the drop in demand for iron due to the housing crisis. The value of inbound shipments of crude oil surged 41.4%, but this was largely due to price increases, as the actual quantity of the commodity purchased was down 1%. Next up, though, we are going to be looking forward at 2023. Hey guys, if you enjoyed the episode, don't forget to hit that like button. And for anyone who wants to go that extra mile and be part of the community that helps keep China Update sustainable, Patreon and Buy Me a Coffee links are in the description below. I hope one day this channel will be fully financially independent, then I can transition to doing this as my full-time job. As always, thank you so much everybody for the ongoing support. This week, Swiss banking giant UBS published new forecasts looking at Chinese consumption in 2023. Demand and consumption will be a bit of a wild card this year. Household consumption, along with exports and private business investment, are healthy components of Chinese growth, and Beijing policymakers are hoping to transition to a growth model fueled by these rather than housing construction and public sector investment. They have their work cut out for them too. By December 2022, domestic consumption's contribution to GDP growth was 52.4%. down from an already low 57% in 2019. As we have explored in recent videos, most analysts expect a short-term burst in household consumption this year from pent-up demand. The questions are, how much and for how long? On the former of these questions, the UBS economists are rather optimistic. According to the Greater China Consumer Research team at UBS, consumption in China is expected to grow 6 to 7% in 2023 year-on-year, outpacing the country's economic expansion. In their report, they argue that consumers are likely to spend more on services as they resume dining out and traveling. Spending on durable goods such as appliances and furniture will also increase. They forecast 15 to 20% growth in home appliances, for example. Christine Peng, head of Greater China Consumer Research at UBS, expressed this week at an event that China's saving rate increased to 32.4% in 2022 from 29.9% in 2019, with the rate in urban areas touching 37%. This increased savings rate will drive the release of pent-up demand in 2023. She believes that excess savings is currently sitting at about 4 trillion yuan, $589 billion. JP Morgan Chase & Co. estimates that this excess savings is closer to 5.6 trillion yuan, or $827 billion. Now, these views from UBS regarding household consumption growth in 2023 is obviously a forecast. We will need to wait and see what happens. We remember that some analysts have warned, however, that the bump in consumption this year may not be as generous as what we saw in developed economies post-lockdowns, as income growth slowed dramatically in China and for an extended period of time during the pandemic. Now, while we're looking forward to 2023, I wanted to end part 2 of today's video with 2 quotes from analysts regarding how Chinese stocks will perform this year. As we will see, the market remains divided. The first is an optimistic view. Quote, "The China trade is probably the easiest story in the world right now. Suddenly you got all the key narratives turning positive all at once, with prices at very depressed levels. There's little controversy there. Everyone is on the same page." End quote. Well, as we look at the second quote, which, looking more at the long term, is more cautious, it appears that not everyone is on the same page. Quote, "We are long-term investors and haven't seen any evidence that the long-term risks of investing in China have fallen. The government is still strongly autocratic, with a sole central decision-maker who is only market-friendly when it suits his agenda." End quote. Okay, next up, and just briefly, while we're moving through the key economic developments from the last week, regulators are pulling back from the 3 red lines introduced to reduce leverage and directing banks to extend credit to developers. British-based Japanese-owned Financial Times writes on Friday that officials at multiple state banks said that they were effectively shelving the leverage curbs. These are the 3 red lines, which refer to the targets for debt, equity, and assets for individual developers. These state-owned banks told the outlet that these no longer affect their assessment of developers. The outlet also quotes the chief researcher of Shenzhen-based Merchants Unit Consumer Finance, who expressed last week, quote, "The 3 red lines are meaningless for now, and nobody talks about it anymore." End quote. Bloomberg confirms what we discussed a few days ago too, that the People's Bank of China, China's central bank, and the China Banking and Insurance Regulatory Commission have directed major lenders to extend credit to, quote, "leading high-quality builders," end quote, in 2023, and help them improve their cash flow and balance sheets. Some commentators have argued that these moves are notable and embarrassing retreats by regulators. Quote, "These moves are a significant backdown from the attempts to deleverage the real estate sector, though so far little has been done on the demand side to spur people to go into the real estate market. Backing down is better than melting down, which is where the sector was headed last year." End quote. Okay, that is today's episode of China Update. Thank you, everybody, for sticking with me. I'm sorry once again about the quality of the recording. Hopefully that will improve once I have my recording equipment back. I hope that my flight will not be delayed again. If everything goes to plan, I should be back with regular episodes either on Tuesday or Wednesday. So I hope to see you all then. Have a great Sunday, everybody.